This week on Wealth Track, a rare in-depth interview with great investor Bill Miller on his pandemic perspective. What's changed, what hasn't?
Yeah, I would say that in this market, and this may sound bizarre given the fact that people think the market is way ahead of itself and all. But I think in this market, even at 3,000, you can pretty much throw a dart at the S&P 500, and wherever it lands, let's put it this way, 8 out of the 10 places it lands, you'll probably do okay.
Investment legend Bill Miller joins us this week on Consuelo Mack Wealth Track.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, a Legg Mason company, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, and Strategas Asset Management.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Today marks the launch of our 17th season on public television. Time is flying. And we are celebrating it by reminding ourselves and all of you why we launched Wealth Track in the first place. It was to reserve a half an hour a week for thoughtful, in-depth discussions with financial thought leaders, great investors, and other best-in-class professionals to help you and us build financial security to last a lifetime. We are marking the start of the season with the introduction of a new series, what we are calling the Pandemic Pivot, the rapid economic, market, and geopolitical shifts we are experiencing during the global health crisis. Through lockdowns and reopenings, the changes have been dramatic and swift. The huge, largely government-induced shutdown of global commerce ended the record-breaking economic recovery and bull market in the U.S. The massive monetary and fiscal stimulus in response led to the shortest bear market in history and what could turn out to be the briefest recession ever, although the jury is still out on that one. As longtime Wealth Track guest, Wall Street's #1 economist Ed Hyman has been telling clients, since May, economic numbers have evolved from really bad to better, to starting a new expansion, to the current, it's a V. Although Hyman also says that it could turn into an L, to be determined. To make sense of these changes, we are turning to a great investor who has been a regular Wealth Track guest since the beginning. He is Bill Miller, founder, owner, and chief investment officer of Miller Value Partners, a firm he founded in 1999 while working at Legg Mason, but took over completely in 2017. Miller holds the unbeaten record of beating the S&P 500 for 15 consecutive years from 1991 to 2005 with the Legg Mason Capital Management Value Trust Fund. His flagship Miller Opportunity Trust Fund, which he created in 1999, has $1.5 billion in assets and has beaten the S&P since the market's March 2009 bottom, producing 20% plus annualized returns versus the S&P 500's 17% returns. For more than a decade, Miller has been aided by Samantha McLemore, co-portfolio manager since 2014 and assistant portfolio manager since 2008. Miller Value Partners has been a Wealth Track sponsor over the past year. I asked Miller his views on how the world has changed since the pandemic.
I'm going to answer that kind of obliquely to start, which is it reminds me of when people used to ask Jeff Bezos, how are things going to change in the future and how do you plan for that? And he said, well, the first thing I want to know is what's not going to change. So once I know what's not going to change, then everything else is kind of up for grabs. So I would say that what's not going to change is basically that the way in which we lived our lives before the pandemic, what we'll try and do is live them the same way that we did, but adjusted for the pandemic. So
okay.
All of the things that we did normally, we're going to want to do normally again to the extent that we can. In the early times, as we are right now in the midst of this thing, social distancing, maybe shelter in place, different lockdowns, which I think are in the past. But travel is very slowly coming back. Conventions, sports, all those things will come back maybe in a different form. So I would say that the only things that are really going to change are things that were already changing beforehand. And so the digital transformation of the economy is one. Shopping online, the people didn't want to have grocery stores, try and order through order through an app to the grocery store. But now that's changing. That's changing significantly. So that's really accelerating that kind of thing. I think that what else is going to change is that we're going to have a lot fewer businesses when we come out of this. We've already got high unemployment, but there's no telling how many restaurants and small businesses will have to close because of the lockdowns. So that's going to be very positive for the ones that were able to go through, the Walmart and Target and companies like that. And then, of course, the digital transformation, all the work from home companies got a big acceleration. And it's not something that is a one-time thing to where we'll tend to go, once all the stores are open again and the retailers, that will drift back to that. I think you've jumped ahead probably a year or two in terms of where we would have been without the pandemic. And then something else that is going to change, or maybe it isn't going to change, depending how you look at it. But what the financial crisis in 08 and 09 led to was effectively, it shocked people so much that they became risk and volatility phobic and took money out of equity mutual funds for most of the last 10 years and put it in bond funds, which worked out well. It worked out well because bond yields are now, just off the lowest level in history. And we saw the same thing this time, which there was a piece in the Wall Street Journal about how over 30% of Fidelity's clients over the age of 65 sold 100% of their stocks and put the money into cash. So that same fear and seeking for safety is going to be with us a long time, which means that probably rates will stay lower for longer, and that has implications for equity valuations down the road.
So, of course, for somebody over 65, that makes sense. But, I mean, it doesn't make sense to go, 100% cash, but it certainly makes sense to take risk off the table because you're not going to replace that income. Investors are still fleeing stocks for the most part, right? And still going into bonds. Does that tell you anything?
Yes, it reminds me of something of my old friend whom you may have interviewed, Ralph Wenger, when he used to run the Acorn Fund. Mm-hmm. And Ralph has a degree from MIT, and one of the things he used to say is risk is conserved in the system, meaning there's always the risk there, it just moves around. And so I think right now that the risk has moved to a level that makes bonds not problematic in the next probably year or two, but very problematic beyond that. We had a 35-year bear market in bonds from 1946 to 1981. Right. And now we've got a 39-year bull market in bonds. And I think that will end at some point. I do think rates aren't going to go back to 14% like we saw in November of 1981, but they could easily go, that 10-year could go from 65 or 70 basis points to 3 or 4%. And if you're in that space, you're going to get just devastated with your money in that.
Bill, let me take it up to an even higher level than what's going on in the markets, and then we will definitely come back to the markets. So this government-induced shutdown that we've had, which I don't think in history we've ever seen something like this except in times of war. And, we've got the record fiscal and monetary stimulus. We basically have the government dominance in private markets. So do you not think that they could have some permanent effect on, what's largely been, a private economy, for instance, in this country, certainly?
I think that question is open at this point. Mm-hmm. I think that the governments initially, when they didn't understand the pandemic and how deadly it might be, I think that they reacted in the only sensible way that they could. But I think that as the nature of the pandemic became clearer, there's a lot of overreach on the part of governments, especially the U.S. government, with respect to the shutdowns and lockdowns. And I do think that there'll be a lot more rationality as this thing winds down. And I don't think the governments will, because it'll be too devastating to the economy to try and go through again what they did before. Right. And I think that's good, by the way.
Uh-huh. You mentioned earlier, I mean, the positive side of the fact that so many businesses are going to fail is that the remaining businesses are going to be stronger and do better. But in the meantime, when you look at that small businesses, I mean, 30 million small businesses in this country with 5 or fewer employees, and they are, they're the bulk of employment of the workforce. So if a certain percentage, a healthy percentage of those, fail, we've got some big problems in this economy.
I think that's one of the worst parts of this whole thing. And, it's just an open question again about what's going to happened there. But I don't understand why, and I haven't heard a good explanation why, if the requirement was that Walmart and Target, for example, could remain open, but smaller variety stores and things had to close. Well, Walmart and Target had to do social distancing. They had to do this.
Right.
Why didn't they allow any business to do that and stay open? I didn't see why they required them to be closed in that regard. It's not like the small businessman really wants to infect a lot of people or have that happen. I think they'd easily be compliant rather than lose their jobs and lose their business. But the thing that worries me is what I alluded to and you mentioned earlier, which is the governments, the legislatures and the governors feeling like that they can be involved at a micro level deciding which businesses are open, which businesses aren't, who gets to, who has to wear what kind of clothes, and the whole thing gets politicized in this highly charged thing. And they've certainly been emboldened by what they've been able to do here, whether it's right or wrong. They're exercising powers that they didn't have before.
One of the primary themes that financial journalists such as myself have been covering is this notion that we've got a damaged economy, and yet the market's in this incredible bull market, and people are calling it the great disconnect. You have a different view.
Yeah, I'm astonished at that, because I guess people are unwilling to actually look and see what the connection is historically between the market and the economy, something you can figure out or find out in 10 minutes. And there is no connection between the two statistically. So from 1930 through 2019, the correlation coefficient on a one-year basis between economic growth and stock market is 0.09, meaning basically none. There's no, it's random. And then if you say, oh, but let's look at it differently. Let's look at rolling 10-year periods. So rolling each year, but taking a long enough period that those 1 years sequentially, won't distort it. Good. Then it's minus 0.04, meaning it's negatively correlated. So when the economy grows, the market tends to go down at the margin. So that would, again, if people are aware of that, and again, you can look anecdotally and see just recently. So what did the stock market do in the fourth quarter of 2018? It fell 20% peak to trough, and we had the worst December since December of 1931, the beginning of the Great Depression, right, and worse than December of 1941 when Pearl Harbor was bombed, which wasn't exactly expected, right? And what happened that quarter? Nothing. The economy grew strongly, unemployment continued to fall, profits. What happened was people just got worried because the Fed was tightening. So a lot more things go into where the market is than just the direction of the direction of the economy. Same thing. Right now we're following a pattern in the economy, which is almost identical with that of 2009. So the market bottomed in early March of 2009. It bottomed here in late March. We had a rally, significant rally into early June, and then the market had a 10% pullback. This is both times, 2009 and now. And so then after that pullback, the market churned around a bit, which it looks like it's doing now. And then we rallied, persistently into the end of the year. And that I think is the market is at least following that playbook, because what's happening also is that you have massive fiscal stimulus, you have massive money supply growth, and things are getting better. Consumer spending was up a record 8%. The retail sales were up 17%. I
know, but Bill, from they had completely collapsed, so of course they're up. I mean, is that?
But the market, as I've said many times, the market predicts the economy. The economy does not predict the market, and the market looks forward several months. Tending 4 to 6 months, and it looks like all the economists that I read think that basically this quarter. This quarter is the one that will be the worst quarter.
Well, the worst. Mm-hmm.
Yeah, and then the next quarter, so the third quarter, will probably be a growth quarter. So, and then the fourth quarter will be a stronger growth quarter. So why would the market, when you have the Fed pumping in massive amounts of stuff, you have inflation at zero, you have interest rates effectively at zero, and you have corporate profits, which have bottomed and will be starting up, and dividends have probably bottomed and will be starting up again. Why would the market do anything but go up in that environment? The question is, how much will it go up? Right. And I think that the consensus numbers right now are around, close to $160 for this year.
The S&P 500.
S&P 500. The market's around 3,000 today, And so that puts it at a little under 20 times earnings. It'd be 3,200. That doesn't seem excessive when interest rates are near zero and inflation is near zero. And in a market where many stocks are expensive, many stocks aren't expensive. I mean, you can buy high quality home builders like Lennar, which has outperformed for 25 years at 10 times earnings.
Which is one of your holdings, right?
Yeah.
There's a concentration in what's driving the market, and it certainly is, companies like, Facebook and Amazon and Apple and Google comprise, I think it's 40% of the NASDAQ and like 20% of the S&P 500. So is that something that should disturb us, that the fact that the performance is in such a narrow and small group of stocks?
Well, I think sometimes the answer is yes and sometimes the answer is no. And I think right now it makes perfect sense for those names to be the leaders because all of them sold off indiscriminately, when the market collapsed in that 4-week period. But then they've all come back and many, if not all the names you mentioned, are now up for the year. And that's because it took the market a couple of weeks to realize, wait a minute, these companies' earnings will be relatively unaffected by this whole thing and their market position will be stronger. So they kind of reverting back to where they were before this pandemic because they're not really affected by the pandemic. And the valuations on those names, exception of Netflix, which is quite expensive, but the valuation on those other names is not demanding. I mean, Amazon, which is up, I think, 35% or so this year, trades right in the middle, right in the median price to sales that it's traded at for the last 5 years. So, and it's still growing at, 25 to 30% a year, which means that it ought to go up, 25% or so a year if its valuation just stays the way it was before the pandemic and people weren't too worried about it 3 or 4 years ago. The other part of the market is that the median stock is still down, probably 20% in the S&P 500. So that's in general, because those names have been hit by the economic slowdown, and some like, the airlines, the cruise lines, people like that, the Disneys of the world, the parks like Cedar Fair, those things have had their business just wiped out, and the market reflects that. And they've come back from the worst levels. And the reason they've come back from the worst levels is that their business isn't at the worst levels. It's come back, although not enough to have them make money yet. But even Delta said they're going to be cash neutral, they expect, by the end of the year. So I think it's, the market's pretty much accurately reflecting the various parts that have been hurt the most and have been hurt the least.
That's, one interesting aspect of this pandemic induced shutdown and the damage that it's caused is when you look back at, for instance, the Great Recession, that it was primarily the financial sector that was hit hard. And so now we have the tourist sector and the restaurant sector. Is this kind of, typical that you have this kind of rotating damage depending on what the cyclical downturn involves?
Yeah, I think the market's pretty good at sorting that stuff out. So in 08 and 09, the financial system itself was on the verge of collapsing, which would have been far more devastating than anything that we certainly saw back then. If it hadn't been for TARP and the Fed finally getting its act together, the system, could have imploded, and that would have been much worse for Main Street than anything that happened with unemployment. But if you go back to that time, yeah, all the banks were down 80, 90% at some point. They were talking about nationalizing them in January of 09. Even after TARP, but utilities and consumer staples, they sailed right through it because they weren't really affected by this, they were the safest part of the equity market. They were affected, but they were the least affected. And bonds, bonds, of course, were a winner at that point in time. Anything that was like a bond proxy was a winner. So the market gets it sorted out reasonably well, though not perfectly, and there are pockets of opportunity always, but when there's a reason for the sorting out that it's done in this thing, and it makes reasonable sense to me.
The big risk, and they always say that the market hates uncertainty, and so the biggest uncertainty really is whether or not we're going to have a second wave, which we seem to be having, or at least maybe it's just an extension of the first wave of COVID-19 cases, and the other second wave that your friend and my friend Ed Hyman talks about is the second wave effects of the shutdown, which you and I alluded to before. But the fact is that, you know, he's kept count of, you know, really the hundreds of layoffs that we're seeing announced. These are laggard, you know, they lag the damage, but we're seeing more and more. That's actually increasing, not decreasing. So couldn't that be a real risk to corporate earnings going forward, and therefore to the market?
I doubt it, and the reason I doubt it is that I think that all of these, you know, Macy's announced 3,900 people today in management are going to be let go.
Right.
All the economists understood that there would be these things would happen at different pace. So I think if the question comes that the actual unemployment rate, you know, starts up, or, you know, new claims start up more than people are expecting, that would be a significant risk, because that would indicate that you know, we're falling back into a problem. So, but I don't see that happening so far. It's just that different layoffs are happening at different points in time. But, you know, all the companies that we talk to say that business bottomed in April, and May was better, and June has been stronger still. Again, we're not talking about a gigantic recovery, but we're talking about things getting better. And I think that will tend to pull other people into the labor force. So you're not going to hear about the companies that are rehiring people because they just laid off, or that they more or less furloughed, so they just sent them home for a while. So I'm not too worried about that. I would be very worried if there was a true second wave that led again to shutdowns. I think that
of COVID-19.
Mm-hmm. Of COVID-19. Because I think that what you're seeing, and the front page of the New York Times today was the CDC said, well, probably 20 million people are infected instead of 2 million. We got 2 million that we got, but when you look at the serology test, a lot more people have antibodies. Well, that's very good, because we didn't know that, and that the hospitalizations that we had haven't changed. So that means that the severity of COVID-19 is far, far less than we thought it was, and I think that's all the data is consistent with that. And what that means is, it might be, you know, some of the areas that they tested, there were like 50 times as many people instead of just 10 times as many people. So we don't know, you know, how many people have been infected. But the fact is that if that ratio goes up, that's very good it's very good for the economy. It's very good for the market, because in addition to whether it might lead to herd immunity or not, it means that this thing is already, the death rate is down, you know, maybe it's double the normal flu rate, but it's certainly not, you know, 10 times the normal flu rate or 20 times the normal flu rate, which would again indicate that the government will not react the same way if the deaths are held at a low level.
We mentioned the narrow leadership in the market, and the fact that you said that there are a lot of other opportunities, that there are a lot of, you know, good companies that are selling at, you know, very attractive values. So tell me where you're seeing opportunities.
Yeah, I would say that in this market, and this may sound bizarre given the fact that people think the market is way ahead of itself and all, but I think in this market, even at 3,000, you can pretty much throw a dart at the S&P 500, and wherever it lands, let's put it this way, you know, 8 out of the 10 places it lands, you'll probably do okay. And there may be some things that it, you know, lands poorly, like if you'd landed on Hertz, that wouldn't have worked out too well. But by and large, I mean, I think that all of the FANGs, even Netflix, if you have a little bit longer time horizon, but all of those are reasonably priced, certainly on more than a 1 or 2 year basis. And, you know, they're very powerful businesses with great cash flows. So I think you can own those. So,
Bill, one investment for a long-term diversified portfolio?
Well, I think anybody that doesn't own Amazon, you think you might have missed it, but its dominance is even greater than it has been. And there's a brand new book out called Bezonomics, which goes into great detail about how Jeff and the team at Amazon think about their business. And when you read that, which I just finished a couple of days ago, I mean, we own Amazon's, you know, our biggest position, or second biggest depending, and on the day. And I'm like, well, I think we're too small in that one. So it's so compelling.
Bill Miller, thanks so much for being with us on Wealth Track, and we are going to see you again next week. So stay right where you are. Thanks, Bill.
Great, thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is stick with your investment discipline. As JP Morgan said, the markets will fluctuate. That they certainly have, but that is no reason for you to follow suit. Know your risk tolerance, stay with your asset allocation, rebalance when it gets out of whack, and make sure you are diversified among risk assets like stocks, safe assets like short-term treasuries, and hedges against disasters like gold. The market will do what it will. You can decide how you will behave based on your objectives, needs, and temperament. Once a plan is in place, the best strategy is to let it work and sometimes sit on your hands. Next week, in part 2 of our interview with Bill Miller, he shares his bullish perspective and how he is putting it to work. In this week's extra feature on WealthTrack.com, Miller shared how the pandemic has changed his professional and personal life. Thank you for reaching out to us on Facebook, Twitter, and our YouTube channel. We so appreciate your spending time with us, especially as we celebrate this July 4th weekend. Make it and the week ahead a healthy, profitable, and a productive one.